Let's get more perspective on today's decision. We are now joined by Robert Kaplan, former president of the Federal Reserve Bank of Dallas and vice chairman now at Goldman Sachs. It's great to see you. So we've heard from some of our guests today, including Paul Donovan at the top of the show, who said the Fed should be cutting already here. And I thought it was interesting how Larry just framed it as insurance cuts. Do you think the Fed is behind the eight ball here?
No, I don't. I think they're well positioned. People have to remember that we've got very restrictive monetary policy, but you have pretty accommodative fiscal policy that's blunting some of that monetary policy. That's part of the reason why the economies remain resilient. But I think they've set themselves up pretty well. I think something like 8 participants said 2 cuts. Another group said 1 cut, and even 3 or 4, I believe, said 0. And I wouldn't be surprised if Chair Powell isn't a little hawkish in the meeting, but all he's trying to do is preserve flexibility, and they're getting themselves prepared to act not in July, but very possibly in September, but they want to see a little bit more evidence of improvement.
And listen, Robert, when you talk about more evidence, I mean, we did get that CPI print this morning. That was a good print. That's 2 in a row. What exactly is the Fed watching for, Robert, exactly to get them more comfortable with the trajectory of inflation here?
So we already have goods disinflation. What I'd be looking at is services, and I want to see more evidence that service sector inflation is moderating. I think we're starting to see that. I think they want to see a little bit more of that over the next couple of months. And it's not an absolute bogey, but I think they'd like to see the trend heading in the right direction.
The trend does finally seem to be heading in the right direction when it comes to housing costs. But, you know, when we hear Jay Powell in the past say something like we need to see more good data, how much more? What kind of length of trend are we looking for here?
So there's a couple of things that are working at cross purposes. So service sector inflation, I'm particularly going to be watching labor and labor costs and wages, because that's the biggest part of it. Rents and housing costs is a little bit odd this cycle, in that it could be higher rates are actually making rents higher, in that they're making houses less affordable, they're making multifamily new projects harder to build, and it's affecting supply where people have to rent. And so rents this time around is one of those odd variables that I think the Fed, and if I were there, I'd be watching independently. But I want to see a little bit more rebalancing in the labor market. And I think that's first and foremost to help service sector inflation.
Robert, if I asked you, to take out your crystal ball here and try to forecast when we in fact do get back to the Fed's 2% target, Robert, do you think that's, is that the time frame back half 2024, or no, this is more 2025?
So the most intelligent answer to that question is I don't know. And I would further give you insight. The folks at the Fed don't know. And that's why they're being cautious. Now, why don't they know? If all you had was restrictive monetary policy, I'd have a lot more confidence that we're going to see a slowing in the economy. But we don't have just that. We have accommodative fiscal policy. We've got these open-ended spending programs like the Inflation Reduction Act, CHIPS Act, and the Infrastructure Act. We also have globalization has become deglobalization, which is increasing costs. You have a very expensive energy transition. And remember, we've got an aging society. So we've got shortages of labor, particularly in the service sector. And so how these cross currents play out, there's really not a textbook for. And that's why I think you're seeing the Fed shorten up a little bit on the prognostications, retaining flexibility, and being more of a risk manager than a prognosticator. And I think that's the right place for them to be.
That said, though, has the dot plot sort of outlived its usefulness, given that, as you say, we don't know what's going to happen in this environment? So should the Fed pause or even retire the dot plot entirely? And if not, what's the argument for keeping it?
So I think it would be hard for the Fed, having used it now for the last several years, to actually retire it. And I actually would say to your listeners, there's actually an enormous amount of useful information in the dot plot. And I would also caution people, if you're a little curious why they didn't do greater revisions to some of the inflation forecasts and other, remember, they may not have had a lot of time between the CPI this morning and change their submissions, but the dot plot's still useful because it tells me what the debate is around the table. It tells me that there are people that are very forward-leaning and want to cut this fall. There are those that are more risk averse and want to see us wait longer. And there are those in the middle. And that gives you a pretty good sense of the debate. So it's actually pretty useful information. Those that want to retire and say, gee, I don't like all this disagreement, I actually think the disagreement's useful and it's reflective of the debate.
It's interesting because we talked to a guest earlier who said the Fed is too unanimous and that there's not enough debate. But just to dig a little bit more deeply into what you're saying, so knowing that you have that dispersion of the dots, like, how do you interpret that? What does that tell you besides just that there is this debate within the Fed? What do you do with that information?
Yeah. And so I would say, by the way, 2 years ago, they were too unanimous. They should have been moving much more aggressively. Right now, there's a reason that you're going to get unanimous votes. The spread between the actions that they should take is not that wide. The reason for the spread is much more, in my opinion, about risk tolerance, a little less about economics. And so, for example, if I were sitting there, I would say, I'm still stung by the transitory lapse 2 years ago. We're maybe on the 5-yard line and wrestling inflation to the ground. What I don't want to do is see a resurgence. And so I want to err on the side of wrestling inflation to the ground. That's my risk tolerance. There are others that might have a stronger sense that the economy is weakening and they're willing to take a little bit more risk in cutting rates this fall. But that's what this is about. That actually is a pretty good debate and a healthy debate. And it makes sense to me. I think the Fed's pretty well positioned, but there's debate going on in the Fed. People shouldn't think there's not debate. There is.
Robert, I wouldn't be surprised. Jay Powell's about to step up to the mic any minute here. If he gets a question about the election, I know, Robert, he'll say, listen, this institution is independent, but they have to be thinking about it, don't they, Robert?
I think to the extent humanly possible, they're divorcing it from their thinking. They're trying to thread this needle. I think they'd like to get themselves in a position, if the data permit, to act in September. And I think if I were sitting there, I would be screening out any election or political considerations. And that's what I think they'll do.
Robert, good to see you. Thank you so much for your perspective. Really helpful, given that you've been inside the room where it happened, so to speak. Good to see you. Thank you.
Good to talk with you.